Today we are digging into one of the most explosive moves we've seen on the market this year. We're talking about Applied Digital Core, ticker APLD.
It was an incredible move. I mean, an 18% gain in a single trading day. That was Friday, January 9th.
Exactly. It closed around 37.68 after just, trading flat for weeks. It just ripped higher.
And that's the kind of move that gets everyone's attention. It just lights up the screens.
It does. And for you, the listener, the big question after a spike like that is always the same. Is this just a trap? Is it retail FOMO, fear of missing out, driving the price up irrationally?
Or is this the real deal? The fundamental start of a new growth story that could actually push this thing towards $50 a share.
That's our mission today. We're going to unpack the analysis reports and figure out if the foundation really justifies this frenzy.
And based on what we've reviewed, the consensus is really leaning toward this being a fundamental repricing, not just hype.
Okay, so where do we start?
Well, I think we need to break down the three core pillars that are driving this. But, and this is important, we also have to talk about the one massive risk that's attached to this whole strategy.
All right, let's do it. Let's start with pillar one, which seems to be this foundation of just hyper growth. The immediate trigger was their Q2 earnings, right?
It was. The market took a moment to digest them, but on Friday it just clicked. And the numbers, they were frankly stunning.
What are we talking about?
Applied Digital reported revenue growth of 250% year over year. 250%.
Wow.
Hitting about $126.6 million. That's not just growth, that's, exponential scaling. It's being driven by this furious demand for AI data center space.
Okay, but that's backward looking, right? 250% is what they did. What really fuels a stock rally is what they're going to do.
Exactly. And that's where the forward-looking pipeline comes in. It's the sheer magnitude of the deals that APLD management is structuring right now.
Okay, so what's in that pipeline?
They were in advanced talks for another 900 megawatts of capacity. And crucially, it's with major hyperscalers.
Let's pause on that term, hyperscalers. We should clarify for everyone, we're talking about the absolute titans here. Right?
The titans of the cloud, the Microsofts, the Amazons, the Googles of the world. When they commit to a company like APLD, it's a huge stamp of institutional endorsement. It's not just retail hype anymore.
And 900 megawatts, help us contextualize that number. How big is that?
It's staggering. To give you some context, that amount of dedicated power is enough to light up a small or even a medium-sized city.
Whole city.
And APLD is dedicating all of it, every last watt, specifically to AI applications. This shows they're building dedicated, AI factories, not just generic data centers.
And I guess the beauty of these huge multi-year deals is the revenue certainty it brings.
That is the single most important detail for a fundamental investor. The company already has a backlog of approximately $16 billion.
$16 billion.
Yes. In 15-year lease commitments. In the tech sector, which is normally so volatile, a 15-year commitment is revolutionary. It basically de-risks the entire demand side of the equation for them.
So how does that backlog change how analysts should even value the company? A tech stock with projections is one thing, but one with guaranteed contracts.
It completely shifts the valuation model.
Yeah.
That $16 billion backlog moves APLD away from being valued like a risky tech stock and closer to something like an infrastructure utility.
Or a data center REIT, maybe.
Exactly. That stability justifies a higher multiple. The market is willing to pay more for each dollar of their revenue because it's secure for the long term. Demand is locked in.
Okay, that makes sense. And that brings us perfectly to the second big pillar here, what the reports are calling the alpha, the real strategic advantage. Because demand is one thing, but actually being able to meet that demand is the new bottleneck in AI.
It absolutely is. For the last couple of years, it was all about the chips. Can NVIDIA make enough chips? Well, now they can. But the problem is there's no place to plug them in. The electrical grid in many major U.S. markets is completely full.
And getting that upgraded takes years, right?
3 to 5 years, sometimes longer. You have utility studies, permits, construction. It's a huge bottleneck.
So APLD has to find a way to get online in months, not years. And this is the part of the analysis that just, it seems almost unbelievable. They're solving this super high-tech AI problem with, 19th century technology?
It's the ultimate technological irony, isn't it? They're using natural gas boilers and steam turbines to generate their own power right on site, next to the data centers.
Wait, steam turbines? Like from the Industrial Revolution? That sounds more like a Victorian factory than a place for futuristic AI. Why is that the key?
Speed. The strategic implication is all about speed and capital efficiency. Building out the traditional grid is slow, it's bureaucratic, you're dealing with monopolies.
Right, the utilities.
By building their own power on-site with proven, ready-to-deploy tech like gas turbines, they just bypass that entire bottleneck.
You said they could be 3 to 4 years faster in the race for AI dominance, that is. That's basically an eternity.
It's priceless. They can start collecting revenue on that $16 billion backlog before their competitors even get their permits approved. It's an almost insurmountable competitive moat, at least for now.
It almost sounds too good to be true. I mean, if this is such a great solution, why haven't the big hyperscalers just done this themselves? They have more money than anyone.
That's a great question. And the analysis suggests two reasons. First, APLD is a pure-play infrastructure company. This is what they do. Hyperscalers want to focus on software and services, not building power plants.
They want to rent, not build.
Exactly. And second, there are still a lot of regulatory hurdles. It's complex. APLD has just mastered the playbook for getting it done fast. Will it last forever? No. But a 3 to 4 year head start is a lifetime in this market.
Okay, so we have hypergrowth and this incredible speed advantage. What's the third catalyst?
The third is a corporate strategy move. It's a pivot designed specifically to unlock more shareholder value.
This is the spinoff, right?
Yes, the strategic restructuring. APLD is splitting its business and spinning off its cloud computing arm.
And that new company is going to be called Chronoscale, and it's merging with EKSO to go public.
This is a textbook play, really. It's designed to address what's called the conglomerate discount.
Which is when the market undervalues a company because it has two different businesses kind of mashed together.
Precisely. You have a data center builder, which is heavy capital infrastructure, and a cloud computing business, which is high-growth software. Under one roof, the market gets confused.
Investors don't know if their money is going to slow-moving construction projects
a clean utility-like infrastructure arm with that secure backlog.
and Chronoscale becomes the high-growth cloud stock.
And history shows time and again that these kinds of spin-offs often create massive value for the original shareholders. They end up owning pieces of two clearer, more focused companies.
Okay, so it's a perfect storm of good news, exponential growth, a massive speed advantage, and a smart corporate move. It all sounds incredibly bullish.
It does.
But we did promise an honest review, so now we have to pivot to the ugly stuff you mentioned, the stuff hiding on the balance sheet.
We absolutely have to, because this strategy is inherently high risk, high reward. Building these AI factories, especially with on-site power, is incredibly expensive.
Aggressive growth requires aggressive capital.
And that's the paradox on their balance sheet. On one hand, they have a healthy cash position, about $2.3 billion.
Which they need for projects and liquidity.
But to fuel that 250% growth, they are highly leveraged. They're carrying $2.6 billion in debt.
Okay, let's frame that risk in concrete terms. What's the specific danger of that $2.6 billion in debt? We already said demand isn't the problem.
The risk is pure execution failure. If these huge deals, like that new 900 million UW project, get delayed for any reason, that debt becomes a ticking clock.
And a lot of that debt is probably floating rate too, so if interest rates move up,
their costs go up immediately, pressuring their margins. Or worse, if there's a recession that cools AI investment and they suddenly need more capital, a stressed balance sheet could force them into dilutive financing.
Which hurts existing shareholders?
Significantly.
Yeah.
So they're making a massive leverage bet that AI growth continues its parabolic trajectory and that their speed advantage holds. If it does, they win big. If it stalls, they're very exposed.
Which brings us all the way back to that core question. After an 18% jump, is it too late to get in at 37.68?
We have to break this down for two different types of people. The short-term trader's view is very different from the long-term fundamental investor's view.
Okay, so let's start with the trader. For someone looking for a quick tactical entry, what are the charts saying?
Well, they're flashing some short-term warning signs. The stock's relative strength index, the RSI, is considered hot.
And hot just means it's moved too far too fast, overbought territory.
Exactly. The RSI is a momentum indicator, and when it's high, it suggests a breather or a small pullback is likely.
And did the technical analysis identify a potential buy the dip zone?
It did. The analysis we reviewed points to a potential pullback zone around the $34 or $35 range. So for a short-term trade, that's a potential target to watch.
But if you're a fundamental investor, you're not looking at the daily chart wriggles. You're focused on that $16 billion backlog, the growth, the energy solution.
Your perspective changes completely. You're buying the company. And given all those foundational drivers we talked about, analysts have been significantly raising their price targets.
So where is the new consensus landing after these results?
The range from the reports we saw is between $48 on the low end and up to $58 on the high end.
Which implies a lot of potential upside from here, even after that big jump on Friday.
It does. The overall assessment seems to be that the fundamentals justify the rally. The feeling is, the train hasn't left the station, it just shifted into high gear. The market is only now starting to price in their true competitive advantage.
Okay, so let's do a quick recap. The 18% surge seems to be fundamentally driven. It's based on, one, that massive 250% growth and a $16 billion secured backlog.
Two, the chronoscale spinoff, which should unlock value.
And 3, the huge time advantage they get by using, believe it or not, 1800s steam turbine technology to power the AI future.
But we can't forget the tension here. High growth requires high risk, and that's the $2.6 billion debt load. Execution is everything.
So we'll close with a final thought for you to consider. We tend to think of innovation as something brand new, custom chips, advanced software.
Right, bleeding edge stuff.
But this deep dive shows a company applying massive debt and century-old technology to solve the biggest bottleneck facing the most advanced frontier of computing.
So what does it say about our modern infrastructure, that the best path forward for AI relies on systems from the 1800s? Is this a sign of brilliant efficiency? Or is it a fundamental warning sign that our legacy electrical grid just can't handle the future?
Something to think about as you watch to see if APLD can hit that $48 target.